Hey, what's going on? Welcome back. Glad you could make it. Today, I'm going to be continuing the series on gap trading. And I'm going to continue this by going over this article that's on the website quantrocket.com. No affiliation with them. I think they make a platform for algo trading. And this is written by Brian Stanley, who I believe is the founder and CEO of the company. And he wrote this article called Should You Buy or Sell Stocks at Gap Down? And since we were making a series on gap trading by request, I thought this would be a perfect example to go over. And I'm actually going to go through this backtest he's written in Zipline, and I'm going to actually code this and trade this with my Alpaca account. So in Visual Studio Code here, you can see that I've already coded this strategy up in Python, and I'm going to share that code with you and walk it through with you line by line so that you understand it. I'm running this on my laptop. You can see this is already shorting some stocks. So this is a shorting strategy, and it's running on NASDAQ 100 stocks or stocks that are members of the QQQ. You can see it's shorting ILMN, Illumina, Okta, Ross, and T-Mobile, and so it's shorting those stocks at the open because they gap down. So it filters for stocks that gap down by a certain amount, then shorts those stocks after 10 minutes. So it waits till 10 minutes after the open, then shorts those stocks and then holds them and liquidates at the end of the day. And that's described in the article that I'll go over in a moment. So I execute this, and I also have this running on a server as well. And in the next video, I'm going to talk about how to deploy this script to a Linode server so that you can run that in a server, have a trade log, and monitor that and so forth, and have that continue to run. You know, you don't want to keep your laptop running at all times to execute this code. You want it up there in the cloud. So I'm recording this video on Friday, April 22nd. You see a lot of stocks actually gap down, so it's a pretty bad day for the market. So a shorting strategy is actually working really well right now. So Illumina, you see it gap down, continue to gap down. You see Ross stores right there, gap down and continued downwards. This strategy also selected Okta stock today, which gapped down, but it went up a little bit after the open. And actually part of the strategy is to short 10 minutes after the market opens. So look, you even got a better entry point here at 940, and the short worked out pretty well. So maybe it's just lucky that I'm running this on a day when the market is way down, but the strategy worked out pretty well today. On my screen here, I have my Alpaca account, so you can see I actually have positions. This is in a paper trading environment so that we can test out this strategy in a realistic environment without risking our capital. Make sure we like it first before we deploy it to a server. Now, even though this isn't part of the strategy that's described on QuantRocket, I actually executed a few additional orders to manage risk here and just to demonstrate some different capabilities that are available here. So I executed a trailing stop order since a lot of people have been asking me how to implement a trailing stop. I also executed some bracket orders as well so that it takes some profit if a certain profit target hits and also stops me out if a certain stop loss is hit. If you want to follow along at home, I've shared the code on GitHub at github.com/hackingthemarkets, and the repository is called Gap Trading. I see some people have already forked it before I was even done writing the code, so this is still evolving a little bit. So if you use this code at home, please note you're probably going to have to add some additional error handling and test this out a bit more as well. I didn't test every possible scenario. So let's first go through this article on QuantRocket and the backtest it provides and understand the strategy that's being presented here and the backtest, and then we'll go ahead and code this up and execute it. And so this article asks, should you buy or sell stocks that gap down? And so what he does first here is try buying the gap. So let's say a stock gaps down by 3%. So it closed at a certain price, like 100, right? And the next morning it opens at 97. So maybe there's some bad earnings news. A great example of this that occurred recently was Netflix. So you see on April 19th here, it was trading in the 340s or so on April 19th. After hours, it reported earnings, and then boom, overnight you woke up and you're down bigly. So Netflix reported slowing growth, and then it gapped down and it went to like 240 overnight. And did it make sense to buy and assume this gap is going to fill and it's going to revert to the mean and go back to 350 or go up at least a little bit? Or is it statistically better to short this stock, expecting it to continue lower? And it looks like indeed it continued lower. So to test this out, he goes through and gets a list of all stocks that gap down and tests what happened after they gap down a certain percentage. And so what he does first is build a universe of stocks, so gets all common stocks, make sure they're liquid, and he wants stocks that are above a certain moving average, so he calculates a 20-day moving average here. So after he gets a list of candidate stocks here, he goes through and finds the ones that gap down by a certain percentage. Looks like he wanted stocks that gap down at least one standard deviation before the prior day's low, so he gets a list of stocks that gap down and then attempts to buy the dip. So when it gaps down, he buys it right at the open, so 1 minute after the open, and then he plots the cumulative returns here, and it looks like it didn't work out so well for him, and so you see if you did that every day, how you would have gradually lost money. And so he says, look, I tried this approach every single day, stocks gapped down, and I bought, and I lost money nearly every single day very consistently. And so he said, you know, if everything I've been doing here was completely wrong, why not do the opposite?
Well, here's your chance to try the opposite. Instead of tuna salad and being intimidated by women, chicken salad and going right up to them.
Yeah, I should do the opposite. I should.
If every instinct you have is wrong, then the opposite would have to be right.
Yes, I will do the opposite.
So indeed, the next thing he tries here is to do a back test, and what he does is actually do the reverse. So he reverses the side of the trade and goes short instead of long. And look at that, up and to the right from 2014 through 2020 here. So looking pretty good. So what are the details and parameters of this strategy? He says the strategy works better on large cap stocks than on small cap stocks. Perhaps it's because small cap stocks are more subject to liquidity shocks, which tend to mean revert. And he also says entering positions 5 to 10 minutes after the open works better than immediately entering after the open. This suggests some mean reversion occurs immediately after the open and before the stock continues falling. And so he said wait 10 minutes and focus on large cap stocks. He also says you can revise the buy on gap strategy. So you can actually buy if you target a smaller down gap and the stock, even though it gapped slightly down, it still closed above its 20-day moving average, and that actually produces a positive equity curve. And so since he suggests up here that small cap stocks are more likely to mean revert and that you can actually buy a small gap down, we could actually create a long strategy as well that buys a small gap down when a small cap stock is still in an uptrend. So we can try shorting big tech or large cap stocks, and we can try going long on small cap stocks that have only slightly dipped. So there you go. The conclusion is that stocks tend to recover after small down gaps and keep dropping after large down gaps. So I poked around on the Quant Rocket site and found this Jupyter notebook that they shared, and this looks like the backtest that generated this chart from 2014 through 2020. So it's a sell gap backtest for January of 2014 through September of 2020. He gave it a certain amount of initial capital and then output the results. Looks like he used a Zipline here. I'm not sure if they have a fork of Quantopian Zipline. I need to talk about Zipline on this channel. I haven't talked about it yet. And then he outputs the results. And you can see for this period of time how it shows an annual return of 8.7%. And one nice thing about this is it had very small drawdown. So if we go down here further on, he plots it against, looks like the S&P 500. And so the green line here is the results of the backtest, the strategy. And you can see it's doing quite nicely. But you can see buying and holding the S&P 500 is quite good. But with the S&P 500, you have to live through these huge drawdowns. But in this case, he shows all these different stress events. So he shows the COVID-19 crash and the large drawdown that occurred at the end of 2018. So the S&P 500 went down roughly 20% during the last quarter of 2018, and during COVID, this crashed by like 33% or 36% or so. Can't quite remember the exact number, but it had a huge drawdown. So if we scroll down, you can see there's tons of visualizations that are provided here, and at the very bottom, he shows the performance during COVID-19. So you can see S&P 500, you had to live through that, which was very hard to do. A lot of people panicked, and here you can see the drawdown was actually very small. And then you can see this huge drawdown during the end of 2018, whenever the S&P 500 went down by nearly 20% right here. He actually made money since this is a shorting strategy. So looks pretty good there, and it looks worth coding. So let's go ahead and get started with coding up this strategy. So here I am in Visual Studio Code, where we spend a lot of time together. And here I'm in the configuration file that I've included. And at the very top of this, you need to configure it. I use Alpaca on this channel because they're a sponsor of the channel. So if you haven't already, please visit Alpaca using the link below. It really helps support the channel and helps me provide this type of content and spend hours on it for absolutely free. So these are the constants you need. So I set up a base URL. Since I'm going to run this at first in a paper trading environment, I use Paper API. And when you're comfortable and you feel really good about this code and you've tested in a paper trading environment, you can switch over to a live stock market environment by changing this to api.alpaca.markets, just like that. You can generate an API key and a secret key, as we've done in many videos on this channel. So you need to use your keys right here. I've also provided a couple universes of stocks here. So I went ahead and just fetched the QQQ, which is our large cap tech stocks that we're going to use for our shorting strategy. And I've also fetched a small cap stocks by just using the contents of the Russell 2000. And so I just hard coded this in a list here. You can fetch this data in other ways. As I mentioned, you can use Alpaca's api.listAssets function to retrieve the entire universe of stocks. And you can also use a number of libraries to load a collection of stocks of your choosing. You can use Yahoo Finance to get that collection of stocks and filter by market cap. At the bottom of this configuration file, I've configured a number of constants. He mentioned looking at the 20-day moving average, so I made this configurable, and I capitalized these variable names so that you know they're constants. So moving average stays as 20, but if you want to change to 30 or 5 or whatever you want to do, you can do that as well. I use 20 because that's what's used in the article. I have a constant for today's date that just runs datetime.date.today, and that just calculates on the day this is running, this stores the current date. Now, to calculate the moving average and also to see which stocks gapped up or gapped down, we need to look at the previous days. And so what I did here is take today's date and then I subtract a time delta. So I go back the moving average number of days. So if it's a 20-day moving average, I need to go back at least 20 days in the past. If I change this to 30, it will set days equal to 30 and I subtract 30 days. I also specify a dollar amount for each order. So let's say you're taking 20 different positions. I just specified $5,000 per order, so an equal amount per stock. You can also calculate your order size a number of other ways. You could take your total account size and then divide it by the number of positions, whatever you want to do. All right, so the next file I'm going to show is the one that's of most interest. So what I do here is just import date time, because we're going to do some date time calculations. I import the config file that I just showed. That way we have those constants available in this script. I import pandas, and I also import sys so that I can exit the program if I would like to. I actually don't need this line here since I'm not streaming data. We're just running this one time 10 minutes after the market opens, so we don't need to stream a bunch of WebSocket data or anything like that. So I just need to import the REST API, so the REST client, and also these time frame units so that I can specify a unit of time when I'm fetching my bar data. Since this is a video tutorial, I'm going to show you all the rows of a pandas data frame. So I'm going to demonstrate this and print it out line by line just to show what this is doing, but you technically don't need this row right here. So the first thing we do in this script is we initialize the API. So we create this new API object here using Alpaca. So we pass it our API key and our secret key and our base URL that we configured and put in the config.py. Next, I check if the stock market is actually open. And so in the first video, I mentioned there was like an Easter holiday and it was Good Friday. And so you need to code around these things. And actually, you don't need to code around these if you're using Alpaca. It actually has a function you can run. And so you can call api.getClock and check this variable is open. And so if the market is not open, you can just exit the script and say, don't run the script. The market isn't even open right now. So you don't need to write all this custom code for that. So that's nice. All right, so next we want to get all the bars that we need. So I'm going to fetch those bars from the API. And since this is the short big tech or short large caps, I'm just using the symbols in the QQQ, even though these aren't all big tech. I'm just kind of calling it big tech. So I'm getting all the daily bars and I'm giving it that start date in my configuration file, which will be like 20 days ago. And then the end date is today, right? And if I run that, I'll get all of the different bars for all these different symbols. And look at that. Now the market is not open when I'm running this and our code worked. And so if I tried to run this after the market's closed, then it won't continue executed. So I'm going to comment this out and just so I can show you what this does. And so I'm going to run this and it should fetch those bars now. And you see indeed it does. And so you can see zoom and zscaler on the end there. And you can see we should have 20 days of open, high, low, close data for each of those symbols. So we have this big list, workday, all these different symbols. Going down further, we use some of the same code that we used in the first video in the Jupyter Notebook where we built that gap scanner. So we create a new column called previous close by shifting the close column. We also compute a moving average. So we look at the previous close and calculate a moving average, so the 20-day moving average, and we store that in a new column here. And so if I do this, and let me comment that out just to show you. So I'm going to print bars now. And I'll also temporarily set the moving average days to 3 just so you can see what this is doing and visualize it very easily. So I'll run this, and you should just see a few days of data. And when I run this again, you see I now have a column called previous close and a column called moving average. And so the previous close comes from the previous day's close. So this 167.40 for Apple here gets shifted down. So look at this row here. So that's for 420 and then 421, and today is 422. So I have the previous close, and then I can calculate a percent and I can calculate a moving average. And so since I just set that config value to 3, you see I can look at the 3 previous closes there and calculate a moving average. So it adds those 3 and divides by 3, and I get this value, and then I can compare the current close to what the moving average was before, because these are all on the same line, and I can also calculate the percent that it gapped up or down. So you can see I have these not a number rows and some extra numbers I don't care about, but I'm just filtering down to the current day for each of these. So the current day is all I care about, and this part is accurate. So I can just filter down this data frame to just the current day. So that's April 22nd. And so I'm going to do a filter here, and I'm going to filter the index, which is this date time. And I'm going to filter and only show the rows here where the day is equal to the current day. So I'm going to create a new data frame called filtered. And then I'm going to calculate the percent that these stocks went up or down. And so if I run this again and print out the filtered data frame I have here, so I'm running that, you see now I just have the current day. So I have one row for each stock. I have the moving average, I have the previous close, and the percent it went up or down. Since I'm looking for stocks that gap down by a certain amount, I can filter on this percent and get any of the rows where filtered percent is less than 0.99. So I'm just going to look for stocks that gap down by 1% or more. So if I print the down gaps for today, I do that, you see I have the stocks like Illumina, which we discussed in the intro, Okta, Intuitive Surgical, and Ross, and T-Mobile. And for fun, we'll load up a couple of these in TradingView. So I loaded Ross stock. You can see the gap down right here. So just to verify that what we're doing is correct. So it gapped down, and look, it continued lower throughout the day. This is the 15-minute chart. And so this was a pretty good short. I can pull up Illumina, and you can see that it gapped down as well and stayed down. So that's looking pretty good. So the next thing we can do is we can add a filter for the moving average. So he adds another condition. So what I'm going to do here is find the down gaps where they open below their 20-day moving average. So we calculated that moving average. We're going to find the stocks where it opened below that moving average. So let's see the down gaps below the moving average. So if I run that now, you'll see it filters down the list, not by much. So now that we have this data frame, let's just get our list of symbols. We talked about this when we did the Jupyter Notebook. Let's just get the list of symbols here. These are the stocks that we're going to trade. So I'm going to remove those print lines, and I'm going to create a couple different symbol lists just to make this more interesting. I'm going to submit 2 different types of orders. So rather than shorting all of them with a market order, I'm going to submit a bracket order as well. So what I'm doing here is taking this list of stocks that gap down below 1%. I'm just going to go ahead and take the ones that gap down below 1.5% and use a market order on the short. And for the ones that gap down more than 1% but less than 1.5%, I'm going to place a bracket order. So I'm going to take profits if it reaches a take profit price that I specify, and also I'm going to specify a stop loss. So this places an order and shorts the stock, and it specifies a target profit price and also a stop loss price. So then all we need is the logic for placing these orders. So I'm getting a list of all these symbols here. And now that I just have these symbols in a list, I loop through all the symbols and I can place orders for each one. So I'm just using the Alpaca API to submit an order. So I'm calling API.submitOrder. I need to give it a symbol, a quantity, and I'm saying I want to short. So I'm going to say sell, and this is going to be a market order. And so what is the quantity, right? We're not just doing a fixed quantity. Depending on the price of the stock, let's say it was Amazon stock, we're not going to do the same number of shares as we would do for a $5 stock, since Amazon's like $3,000 a share. And so I'm going to calculate this quantity. So I specified a configuration variable, the order dollar size of $5,000. And I'm just going to divide by the opening price. So I'm going to get that last price. So I'm going to get this row and get the opening price and then divide to get a rough quantity. And I use this double slash here because I want a whole number. So when you're shorting stocks in Alpaca, you can't do fractional shares. But when you're buying and going long, you can actually do fractional shares there. So we'll do fractional shares on the small cap example. For each of these orders, I'm going to log a message. So I'm just going to use a simple print statement. So I'm going to say I'm shorting a certain symbol at a certain price. So I'm going to log the timestamp, I'm going to log the quantity and the symbol, and I'm going to log the opening price of the stock. And then when we run this on the server, I'm going to capture this output to a log file. Every time we submit an order successfully, I'm going to log a message. So I'm going to print successfully submitted market order with order ID. So I'm getting the order ID that's returned from this submit order call, and it's going into this order object. So I'm going to log the order ID here in case I want to look up and debug this later. The other thing I need to do for debugging is inevitably some things are going to go wrong. For example, your account could run out of money if you shorted too many stocks, or something could be wrong with your order for whatever reason. Maybe the stock is halted, or any number of things could go wrong. You lost connection. And so I'm going to catch any exceptions that occurred and log them here. And when we go to our log file, we'll have a record of that exception. And then later on, when we look at this, we can see what could have gone wrong and fix those so that we have less bugs in the future. So at the bottom here, this is where I submitted the bracket orders. So there's a little bit more logic here. And so I'm going to comment this out and walk you through it. So I get a quote first. So I want to get a price for the bracket order, because whenever I'm submitting a bracket order, I need to specify a take profit amount and also a stop loss amount. And so I calculate a variable called take profit and a variable called stop price up here. And I just used a percentage here. So I got a quote and took the price, and then I said a take profit if the stock goes down by 1%. And then I also calculated a stop price here. So if the trade goes against me, I short the stock and it goes up by 1%, then I will get stopped out. And I just did 1% for simplicity here. Technically, you should probably have a better reward than the amount of risk you're taking. So for each of these, I calculate a quantity. I log that we're shorting the stock at a certain price. We submit the order. So this is the structure for a bracket order. You need to specify the order class of bracket, and you need to specify these two dictionaries, a take profit price and a stop loss price, where you specify a stop price and a limit price. If that all goes through and we got an order object back, then we can log that it was successful and we print out the order ID. And if there's an exception, we write out the exception and print out the exception, and we'll have that all logged to the file. And so if we run this and all works as planned, we should get some messages here. And look at that, you see it ran. And so I have a timestamp saying shorted 18 shares of Intuitive Surgical at 274.92, successfully submitted market order with order ID, and I have an order ID, and then I have one record for each one of these stocks. You see the first one here was a market order, and then the rest of these are bracket orders. You can also see there's a few exceptions that I logged here. So you see we caught the exceptions and printed error executing the above order and printed the exception. So it says error executing above order, and then we got an exception, and the message is here, stop loss, stop price must be greater than base price plus a penny. So that was unanticipated. I didn't plan for that to happen. That's why it's important to catch your errors and log them. So I think the problem here is when I tested this earlier, the market was open, but now the market's closed. It looks like I was fetching the latest quote right here. And so I need to check on how I'm calculating the take profit, stop price, and limit price right here. And I don't feel like going into that right now, so I'll try to get that fixed up and post it to the repository. So that was the short big text script. So the other script I have in the repository to go over is very similar, but it's called long small caps. And so this is initialized nearly the same way. So I set up the Alpaca API and I get bars for the day. But instead of symbols in the QQQ, I'm using IWM, which is the small caps index, the Russell 2000. So this time I'm looking for small cap stocks that gap down but are still above the 20-day moving average, and then I filter them down and I get market order symbols and trailing stop order symbols. And so again, I'm submitting two different types of orders here. So I'm submitting a limit order here, so I'm calculating that based on the open price. So I'm choosing a limit order, so this may or may not fill. And I'm also submitting a trailing stop order. Now, this isn't part of the strategy on the Quant Rocket article. I just did this for some variety, and also since people had asked about trailing stop orders. So on Alpaca, what you do is you submit the order, you give it symbol, quantity, buy, and you give it a type of trailing stop, and you just need to give it a trailing dollar amount or a trailing percent amount, just like that. And I just did a trail percent of 1%. You can technically use the ATR or 2 times the ATR or another type of calculation to make this trailing stop a little bit more dynamic. Once again, if the order is successful, we log a message. If the order is not successful, we log a message as well. And I can run this, and again, you see the market is not open, so I'll comment that. out real quick, and let's see if we can place some orders. And so this is placing orders while the market is closed technically, which means a lot of them aren't going to be filled. So I just submitted these while the market was closed, and indeed those orders are submitted, but they're probably not going to get filled. So you can see in my Alpaca account, these orders are actually placed. I'm going to cancel them real quick and just show you. So I'm going to run that, cancel the orders, and I'm going to run this script one more time just so you can see this happen and appear on the screen. And just like that, you see the trailing stop orders are submitted right there, and you see a stop price for each one of these orders for small cap stocks. Now, if I run this over and over again, you'll see how I got that message saying I had insufficient funds. So there you go. You see I submitted it, and you see our exception catch is problem submitting above order, insufficient buying power. And so you can see when you're trying to code a strategy, there's going to be all kinds of issues you run into. Your account running out of money, the market being closed, you calculating your stop loss incorrectly. So this is just a start. I've put a lot of time into putting these code samples together, video tutorials and all this, but at the end of the day, there's going to be problems that occur that you're going to have to handle, and you're going to need to write additional code to make all these strategies your own. The final script I'm going to show you here is called liquidate.py. As mentioned here, the strategy goes to cash at the end of the day, so 5 minutes before the close. We're going to run this script called liquidate.py. So this sets up the Alpaca API the same way, but we're going to just cancel all open orders. So if there's some of these limit orders we place that never filled, we can cancel them. And then finally, we call api.close all positions to close any positions we have and go all to cash. That way we can go to sleep at night knowing our cash is safe. And then in the log file here, we're just going to print at a certain timestamp, we liquidated our positions. And so that will be in our trade log record. So there you go. We went through the reasoning behind this strategy on Quant Rocket. We went through this back test that was published, and we translated this to Python code ourselves. So mission accomplished. We are successfully executing some orders in our Alpaca account, and that's getting logged to the console, and it's running on our laptop. So in the final video of the series, I'm going to show you how to configure Linode and deploy some of these scripts to the cloud so that they execute every day without your intervention. So thanks a lot for watching this video. Stay tuned for the next one. Thanks.